So let's just cover this. Let's go over to the total cryptocurrency market cap. I have all of the fundamentals drawn up. And the reason why I like doing this for you guys, even though it might seem boring, is so that way you all really truly understand what is driving liquidity inflow and out of these digital asset ecosystems, and you can physically see examples. So what you'll notice in this breakdown is the primary drivers of liquidity into and out of risk assets are central bank positioning, geopolitical risks, and shocks to the financial markets in the form of currency trades or, again, just central bank positioning. All right. Those are like the two primary factors outside of economic conditions that spark recessionary fears or boost economic activity that we see primarily affecting these asset classes that we trade, in this case, crypto. All right. So we pay attention heavily to central bank positioning, geopolitical tensions, and economic risks or, economic stability, strength, or weakness that could weigh sentiment, either driving demand for risk assets or demand away from risk assets and into safe haven assets. So I want to really break this down for you guys because pretty much if we go back in time, since we're at the end of the year, back at the end of 2023 in October, starting there is where we're going to start today's video breakdown. And I want to show you guys the environment when it was risk on, how it shifted as we headed into 2024 back in March, April to risk off, what factors created that sentiment, and then show you a physical rounding in the bottom that just recently took place in crypto in August as we shifted. And you'll see that in the form of all the fundamentals that were weighing on price in March. Once we go through this, you guys will see started to shift hands in August. And we started to see scenarios and fundamentals unfold that actually supported more risk asset buying, like interest rate cuts, lower inflation readings, de-escalations in Middle East tensions compared to the beginning of the year, Bank of Japan rate hikes off the table, things of that nature. All these things that we talk about that drive more demand into risk assets started to fade away. And now, then I'll get to the report today, the current market landscape, some of the immediate factors this past week that supported risk asset buying. And then we'll end this call with what to be paying attention to moving forward, the primary factors that we as a community need to pay attention to, considering that now we are operating in a premium. So all the things that could weigh on risk sentiment when the market is greedy, when the rest of the market is not humbled by these things or even paying attention to them, as crypto prices start to increase in value, we need to pay more close attention to the things that could give us a signal that it's time to take some profit. So, I'm going to start from the very beginning just so that way this is a good detailed breakdown for anybody that hasn't paid attention to these types of breakdowns before. I do them from time to time, usually like once a quarter. We do like a full spectrum breakdown. So this is going to be that one for Q4. All right. So let's start there and then we'll progress up to this point and then talk more so immediate about this past week. So let's start back. Let's talk about the risk on market environment and the bullish environment that was created as we rolled into 2024. This was towards the end of 2023. Without me pulling up these fundamentals and expanding them, can anybody tell me, if you remember and you've been a market participant in CYPRX or you've been paying attention to these market dynamics yourself, what was one of the key things that started to shift and create a risk on market environment towards the end of 2023 as we headed into 2024? And I'll give you a hint. It had to do with the
Announcement of Fed rate.
Okay, good job. Whoever said that, Alex, I believe it was, right? We started to see, because you literally took the words out of my mouth. We had the expectations towards the end of 2023 start to heavily impact the markets that central banks heading into 2024 were going to start to cut interest rates. Okay. Primarily in this case, in this scenario, we're just going to fixate our attention on the Fed. So all of these reports that I have for you guys today that I've drawn up and taken screenshots of, there are dates where you can see this information came out. All right. So here you can see, and good shout out to Alex for that one. Appreciate you. Dovish Fed officials boost Wall Street, right? Boost risk asset investing as bond yields retreat. This is from October 10th, 2023. And it says right down here, Wall Street indexes closed higher on Tuesday to notch their third straight day of gains after dovish comments from U.S. Federal Reserve officials pushed Treasury yields lower as investors cautiously monitored developments in the Middle East. All right. So then it goes on to say Raphael Bostic, Atlanta Fed president, said the U.S. central bank does not need to raise interest rates any further and that he sees no recession ahead. So this is like the first really good fundamental that I could find that supported this current environment that we're living in now, where we're seeing a possibility of the Fed achieving a soft landing. Okay, and I've gone over that and I'll continue to go over that in these fundamental breakdowns. We'll get to that point once we get there in today's report from November 8th. But you can see that back in October 2023, we started to see the sentiment come into the market, and this supported risk asset buying. You can see what type of effect that had in the digital asset ecosystem. Here you can see this green circle is October 2023, and we started to see buying of risk assets, particularly in this case, crypto. Moving on, in February, can anybody tell me what happened in February that continued the risk on sentiment and supported the narrative that the Fed at some point in time in 2024 was going to usher in aggressive rate cuts? Again, I'll give you a hint just to prolong and go through this call. It has to do with the economy and something that we pay attention to very heavily here at CYPRX that's not labor market data. It's that other key data point that sways Fed or central bank sentiment. Can someone tell me what that was?
I think it was geopolitical tensions.
Okay, almost, but not there quite yet. We're not there at geopolitical tensions just yet. Think more so of the economy, think more so of data, and think more so of outside of labor market. What is another key metric that the Fed pays attention to make decisions on monetary policy?
PC.
Okay, good job, right? Inflation. Good job, Alex, again, right? So in February, we got January's inflation report because remember the inflationary data lag. So like next month, we'll get the previous month's report. Okay. So the data always lags. So in February, particularly on the 12th, this article reads, we got the January inflation report. In the US, inflation, according to the January report that we got in February, showed signs of continued cooling, right? Inflation continuing to come down towards the Fed's goal of 2%. I'm not going to bore you guys and read this article, but that was one of the primary factors continuing to drive sentiment towards risk assets, because what does cooler inflation do via the expectation of central bank positioning? Again, just answer that rhetorical question in your head. It sets a precedence or a market expectation of further rate cuts, or at least no further rate hikes, which is something in the market's eyes that creates a risk on market mood. And so we saw in February that risk on market mood continue. As you can see here, this is February 2024 when this data came out, and risk asset buying prevailed. All right. So now moving into March. What started this market turmoil? What created the pullback environment, the risk off market sentiment? It was literally the opposite of the data that we got at the end of 2023, rolling into 2024 on top of two other contributing factors. So that means four things were weighing on prices most recently since March, when we had a top at $2.7 trillion down to where we bottomed in August. Let's start to talk about those things. And before I go through these fundamentals, let's just have an open discussion about it again. Can someone give me one of those four things? We'll try to name at least three that was weighing on risk sentiment in 2024. Just give me one. Somebody give me one.
Rate cuts.
Okay, a pushback on rate cuts, right? The market started expecting less aggressive cuts from the Federal Reserve due to an increase in inflation and due to upbeat economic stability in the US. Good job. What's another thing that happened in 2024 that weighed on risk sentiment from March until about August?
Is it Ukraine? The Ukraine war, or that tension over there?
Okay, I'm not going to necessarily say it's pinpoint as the Ukraine war, but we'll just go ahead and chalk that up to geopolitical escalations and tensions, right? In 2024, we saw massive geopolitical escalations and tensions and headlines breaking almost every single week up until this point, most recently when we started to see ceasefire talks in 2024, whether that had to do with Ukraine or the Middle East. So good job, AP. Just at the end of the day, we'll just chalk that up to geopolitical tensions. So far we got rate cut pushbacks, we got geopolitical tensions weighing on risk sentiment. What were the two last primary factors that weighed on risk sentiment in 2024?
Get the yen carry trade.
Oh,
Yeah.
beautiful, beautiful, Richard, beautiful, right? So good job. We had the yen carry trade. Now that took place towards the middle of 2024, roughly in the end of July, rolling into August. And we'll get into that in just one second. And then what was the last one, the fourth piece that, again, because there were some other contributing factors that weighed on risk sentiment, but the four primary factors were first, pushback on rate cuts. Second, Middle East tensions and geopolitical escalations, just in general, right? Whether that be in the Ukraine or Russia, Taiwan, or China, Taiwan, whatever it was, there were some massive geopolitical tensions that aroused in 2024. And then you guys just mentioned the yen carry trade. What was the last one? Now think back to the
Persistent inflation.
let's think more so economic data and think of economic stability or instability. What happened?
Unemployment numbers.
Yeah, jobs data.
Good job, Dane, or whoever said that. I think it was Dane, right?
Yep.
We
Yep.
got the horrible NFP report at the beginning of August. I believe it was the 2nd of August. It was a Friday. Okay. We had a horrible misprint, and the market came, like, this environment came over that we were going to jump into like a global recession. I don't know if you guys remember the headlines, but again, when there's recessionary fears amongst investors, that tends to create a risk-off market environment. Investors with much more money than you and I, they tend to flock to safe haven assets. Okay. So good job, everybody. You guys are getting your brain juices flowing. You're starting to see this. And so let's get into detail on when these all came out so you can physically see this represented on the charts. So just to support, in March, we saw a pushback on rate cuts. I don't remember off the top of my head who said that, but here you can see the article. March 12th, 2024. Inflation, again, because it's lagging. So the inflation that we got from February came out in March, and it was higher than expected. You can see it says the Federal Reserve is likely to take its time before cutting rates. Again, that was one of the primary things. We had that shift in sentiment where previous to this month in March, the market was heavily pricing in interest rate cuts from the Fed, which created demand. Well, in March, for the first time, breaking headlines showing a rise in inflation stalled that ideology that the Fed was going to cut rates or cut rates as aggressive as they were. And that created a profit-taking environment or a risk-off environment. And investors started to buy assets like gold and the dollar and other safe haven currencies. All right. So that was one thing. Moving on into February and March, or sorry, excuse me, February, give me a second, March, April and May, excuse me. All right, so here is a Reuters article. You can see this is from April 14th, 2024. Now, I believe the actual event took place on the 13th, from what I remember, but Iran launches retaliatory attack on Israel with hundreds of drones. And you can see the effect that that had in April, mid-April. This is the 15th. That's actually the day of my birthday. I remember it so clearly, but the market completely tanked. We went from roughly about 2.6 trillion all the way down to about 2 trillion flat in April. Okay. And this was primarily due to some of the Middle East tensions and escalations, which, again, bravo and kudos to you guys for calling that out. Then you can also see here, this is another article from April. Bets on rate cuts this year are fading away. So we started to see more pricing out of aggressive rate cuts from the Federal Reserve, or pricing in of less rate cuts from the Fed, if that makes sense. Okay. And again, we know that less rate cuts from the Fed, that ideology tends to do what? It tends to drive demand for the dollar. As the market starts to price in a higher for longer interest rate environment, a higher for longer interest rate environment historically has tended to weigh on risk assets, right? Then moving into June, all right? So here you can see another fundamental piece from June. It continues to say, Israel-Hamas war escalates, Middle East tensions escalate. These are all fundamental articles from June. And we can see again, June, relatively speaking, after some profit taking, was a bearish month. Okay, where again, we failed to break a previous high from previous months back in March and April, and we created another lower high, lower low formation rolling into July. Now, July, again, bravo to you guys, is when we saw at the end of July, when we had that massive sell-off from roughly about 2.4 trillion rolling into August, all the way down below 2 trillion, down to like 1.6 trillion, we saw the massive unwinding of the yen carry trade. Okay, this you can see is from August 5th, 2024. So end of July, beginning of August. Investors are unwinding the biggest carry trade the world has ever seen. Now, this is going to play an important role in a second when we get to playing chess with the markets and we start to talk about the things that could unfold rolling into 2025 that we still have to get through in order to say, okay, yes, a bull market is 110% coming. We are all about to be freaking crypto millionaires. We have to get through one of these things with the Bank of Japan, and we'll get into that in just one second. But a rapid unloading of the carry trade extends on Monday, with market participants seeking to roll back the popular trading strategy amid a dramatic sell-off in risk assets. This article from CNBC reads. All right. Now, at the same time, I think it was Dane that said this. We had the bad, horrible NFP report. Well, here on the same exact day that bad article came out with the yen carry trade, on August 5th, again, we see poor jobs report sparks recessionary fears. Okay. So all of this led up to this massive pullback or billions of dollars being liquidated from crypto as uneducated buyers that marry this greedy bias or this one direction bias, don't know how to react to these things, continued to buy, creating liquidity for these market makers as these market makers were selling the positions and liquidating anybody with buy stops, right? So, or stop losses for buy positions. That's what you're going to see on the news articles. You'll see, oh my gosh, massive buy liquidations today as the cryptocurrency market continues to sell off, right? So that was the environment that was created up until about August. Now, August, when the market had bottomed out at $1.7 trillion, which we were covering at the time. I had been taking Fibonacci's from this previous low up to this high in March and telling you guys that the market was at a discounted environment. We were getting into assets like soy. We were getting into assets like Arrow. We were getting into multiple different digital assets across the board. Brett, right? Brett at 4 cents. All those assets that I just showed you guys are up in terms of percentages now. We were buying back in August when everybody else was fearful. And the reason why we were doing that is because we started to see the fundamentals start to shift hands. Okay. So I'm just going to continue. I won't question you guys anymore. So that way, excuse me, this video breakdown isn't too extensive. But think of all the things so far, the 4 primary factors that weighed on risk sentiment. And I'm about to show you guys how easy this is. Because now, inverse to where we are at now, back to about August when the market started to turn around, all you literally have to do is go into the fundamentals and see that all of those things that were weighing on risk assets previous months have now changed. For the first time in August, you can see in the form of reports, we started to see August 20th, 2024, Middle East tensions ease. Now, although this is an article about oil, it's still the same market, the same sentiment, the same environment. And it was for the first time since pretty much March, when escalations started to increase, that we actually saw the mention of a possible ceasefire or de-escalation start to take place. Obviously, of course, nothing has been solidified, but it was honestly the first article in terms of dates that I could find that had the key vocabulary easing Middle East tensions or de-escalations or ceasefire talks. That's why I tell you guys and I teach you to pay attention to key vocabulary, okay? So that was an article that we found in August. And again, we saw an increase in price action or a bullish month in August, right? Then rolling over into September. So let's just pull up some articles from September. If you guys remember at the beginning of September, what was set to take place? Actually, as a matter of fact, I do want to ask you guys this question. Hopefully you didn't see that. What was one of the major impactful things that not only happened in September, mid-September, but leading up to that major impactful event, what did the market start to heavily price in at the beginning of September? Can anybody tell me?
Was it the rate cut?
Rate cuts, right? At the end of August, rolling into September, the market started to heavily price in a 50 basis point rate cut from the Federal Reserve, which is the biggest rate cut that we've seen in years, right? So then middle September, you can see September 19th, 2024, the Fed cuts rates by half a point to support the economy, right? To support the horrible jobs data and everything that we were getting via the bad economic data, or I'd say I wouldn't call it horrible economic data. I think the market overreacted, but the misprint of data that we got in August, the Fed decided to cut rates via 50 basis point cut. Okay. And so obviously, of course, rate cuts over time tend to ignite risk asset buying, right? They make it a more favorable environment for investors with much more money than you and I to take on risk, right? So we saw that happen. That was one of the primary factors that led to a continued bullish month in optimism in risk assets as we rolled into October. Then in October, same factors that were weighing on risk assets started to continue to change hands. Where in October, the inflation reports that we got from September, because again, the inflation reports lag, you can see these inflation reports came out on the 10th of October, 10/10/2024. The inflation rate in the US slowed for the 6th consecutive month from 2.4% in September to its lowest since February 2021 from 2.5% in August, right? So I'm not going to again bore you guys to death, but what does lower inflation readings tend to support? Further rate cuts, which now in November, what did the Fed just usher in again? rate cuts. Okay. So the environment from risk off started to change in August to risk on with supporting fundamentals like rate cuts, economic stability, Middle East tensions, right? All of these things, all of these factors that were weighing on risk assets before started to change hands. One of the primary drivers, again, that weighed on risk before, that has ceased to weigh on risk most recently, is the dovish commentary from Bank of Japan. It has been the lack or the decrease in fear that the Bank of Japan was going to hike rates again this year, right? And so right now, as we roll into the more recent sentiment this past week and then doing our forward projection, this is going to be one of those key factors that we need to pay attention to. Okay. So this is an article you can see from September 20th, 2024. Bank of Japan UEDA turns dovish as the possibility of year-end rate rise fades. So the market started to price in that the Bank of Japan was going to hold rates steady instead of hiking them like they did in July, which again supports risk asset buying and weighs on the strength of the Japanese yen. All right. So I just wanted to show you guys leading up until now, until November, when we read this report, what created the sentiment prior to 2024 as we ended the year in 2023. In 2024, what weighed on risk sentiment and what now has changed. So that way we can play chess with the market. We can know what fundamental drivers suck liquidity from the market or add liquidity to the market. Because this is going to allow us to be reactive and adaptive if we start to see breaking headlines based off of historical data and how the market reacts to a risk on, risk off sentiment. Okay. So moving on, let's go to our November 8th, 2024 report, and let's break this down and get just a gist of what and why the market is bullish. Because obviously, of course, there's some factors in this article that I know for a fact I left out, like profit taking on gold. I've touched on that before. Usually when there's profit taking from safe haven currencies that people have been aggressively buying, for example, gold. Why have people been aggressively buying gold? Because of the Middle East tensions. Well, now that the Middle East tensions are starting to dial back, which it's not solidified that they're going to dial back yet, but as of right now, there have been no escalations. So that has been one of the things that has led to profit taking on gold. Well, if investors are profit taking from gold, they're going to want a place to put that currency or to put that capital to hedge against gold declining in value. And then that's where, again, the risk on market environment tends to take place. So we've seen a lot of that capital from profit taking on gold come into crypto. I didn't write about that in this report, but again, I just touched on the primary factors in this report leading to a risk on market sentiment. All right. By the way, before we carry on, do you guys see how fluently and easy it is for me to talk about this stuff? Okay. I'm going to tell you all this right now is that 3.5 years ago, when I started studying fundamentals, I probably sounded like an idiot talking about this stuff. I had no idea what the vocabulary meant. I had no idea what really drove liquidity or liquidity out of these assets that I traded. And I'm telling you guys right now that what really allowed me to level up in my trading and investing career was understanding this stuff in a simplistic way where I just saw what created demand or less demand for these assets. Supply and demand dynamics, as basic as that sounds, is important to learn. And when you learn these things, these principles, the key here is, and the sauce of it is that they don't change. Like literally next month and the month after, and in 3 months from now and another quarter from now, whatever, we're literally going to be paying attention to the same things because the data, if you go on forexfactory.com, it repeats itself every single month. And so you get the hang of it. Okay. At the beginning, you might not understand it and it might seem, a little dodgy. But once you study it more and you actually participate in the live markets when these things unfold and you see them in real time, you start to realize, oh my gosh, these fundamentals combined with a solid technical analysis strategy, whether it's you use mine, the 2.0 strategy, or you use Usman's approach with the order flow, right? You become a freaking sniper in these markets. And it is possible for you to call out bottoms and it is possible for you to call out tops because you're being reactive and adaptive to changing market conditions. All right. So moving on, let's go through this. So today, the total cryptocurrency market cap surged by over $20 billion, which I believe right now it's probably, let's see, it's probably up more than that. About 23 billion, not too bad. Adding more than $300 billion of inflow since the market bottomed on November 3rd. Several key factors are driving this risk-on environment. First, the recent landslide victory by Donald Trump has contributed to a boost in risk sentiment. Excuse me. As markets anticipate potential de-escalation in global conflicts, for instance, a ceasefire or reduction in tensions in regions like Ukraine and the Middle East could alleviate geopolitical risks that have weighed on the crypto market, which now you guys know about. Reducing the uncertainty in these areas, would likely encourage renewed buying of risk assets, as stability in global affairs often strengthens investor confidence. Soft landing. Remember, back in October of 2023, it was the first time that we saw the soft landing narrative come into play. Well, that is continuing to drive risk on sentiment now in real time. So soft landing and economic support. Another significant factor supporting risk sentiment is the growing expectation that the Federal Reserve may achieve a soft landing for the U.S. economy. A soft landing refers to a scenario in which the Fed successfully slows inflation and moderates growth without causing a recession. This balanced approach reduces the need for sharp rate hikes, supporting a stable environment for risk assets like crypto. Recent economic data that we got today underscores this possibility, which we talked about in previous reports and we covered in today's report. The Atlanta Fed's GDP Now model estimates Q4 GDP growth at 2.4%, while the New York Fed's Nowcast projects it at 2.0%. Supporting a soft landing, productivity is expected to keep inflation low, encouraging steady economic growth, higher retail interest rates, and long-term currency appreciation. Additionally, consumer confidence showed improvement in November, with the University of Michigan's Consumer Sentiment Index rising to 73 from October's 70.5. The Consumer Expectation Index also increased to 78.5, signaling optimism for the future. Low inflation expectations, a 2.6 for 1 year and 3.1% for 5-year outlooks, suggest that inflation pressures may remain contained. Stable inflation and positive consumer sentiment are key pillars of a soft landing, as they signal resilience without rapid economic overheating, which is favorable for risk assets. So this metric of the most recent consumer confidence or consumer sentiment report is the inflation report. That's one of the key things that we're going to, again, pay attention to as we get into the outlook moving forward. So I'm just going to fast forward to that real quick. The two metrics that we're going to talk about moving forward that I feel like a lot of people are not paying attention to that could still weigh on risk as we head into 2025 are an uptick in inflation if it unfolds due to some of the policies that Trump might bring to the table, and the unwinding of the yen carry trade. Those two factors, outside of tensions rising in the Middle East or just on the geopolitical forefront in general, are the primary factors that we are going to be paying attention to moving into 2025 to potentially call a market pullback or see that a market pullback might unfold. Okay, so let's continue. Rate cuts and global central bank policy. In line with this optimistic look, obviously, of course, we talked about major central banks are easing monetary policy. Let me mute you guys real quick. Somebody's scratching the mic and that shit's messing with my flow hardcore right now. They're easing monetary policy with both the Federal Reserve and the Bank of England this week, cutting interest rates by 25 basis points. Lower interest rates, obviously, of course, we know, reduce borrowing costs, encouraging spending and investment in riskier assets via larger organizations, businesses, and institutions. We have also had the Bank of Japan recent messaging, which avoided any announcements of future rate hikes in the near term. This has eased fears of the yen carry trade unwinding that could have disrupted markets if it unwound further, which we'll get into again in just 1 second. Geopolitical and regulatory developments. The outlook for risk assets is also benefiting from the recent geopolitical shifts. Trump's election win has raised hopes for potential ceasefire discussions in Ukraine, as well as de-escalations in the Middle East. I won't bore you guys to death, but here you can see I added both of those fundamental pieces so you guys can read through them. Lastly, ongoing regulatory progress and increasing institutional interest continue to drive momentum in the crypto sector, which is again why I believe that even if we do experience some short-term price fluctuations to the downside or any liquidation shocks that decrease prices, it's supposed to or should be seen as an opportunity. Because long-term, we all know that this digital asset space, looking back in 3 to 5 years, is going to look like a damn hockey stick, okay? While the market currently trades in a risk-on environment, we must stay vigilant for factors that could shift sentiment to a risk-off, impacting crypto prices in the future. So before we get into those factors right now, is anybody confused about what happened end of 2023, rolling into 2024, mid 2024, the meat of 2024, and then up until where we are at now? Why your portfolio's in the green right now, hopefully, unless you were buying back in 2021. God bless your soul. Outside of that, is anybody confused on the fundamental forefront right now at this point in time? All right. So as we transition, now that you guys are up to date, we've done a full look back, a full spectrum of what happened this past year. There should be no confusion on what's happening in the now. What do we need to pay attention to moving forward as price starts to trade in a premium? All right. One of the main things that I'm looking for is the potential shift in US monetary policy, where right now everybody's extremely euphoric. Everybody's like, rate cut, oh, foaming out the mouth. Oh my gosh, rate cuts, it's game on. Let's over leverage buys and freaking send it to the moon, right? Wrong. The potential shift in monetary policy is still on the forefront or the table. So though the Federal Reserve recently cut the Fed funds rate by 25 basis points to a target range of 4.5 to 4.75, questions remain about the path of future rate cuts under the upcoming Trump administration. Economists are concerned that Trump proposed economic policies, particularly tariffs and fiscal expansion, could create inflationary pressure. Now, I highlighted that key vocabulary in red because that's something that we need to pay attention to moving forward on a data-dependent basis. I just told you guys that this data, PCE, CPI, all of these inflation metrics come out every single month. So we need to pay attention to them, because if we start to see an increase in inflation month after month, year after year reports come out, then we know what that's going to most likely do to the sentiment. It's going to push back the rate cut sentiment. It's going to usher in this mindset, this narrative via these markets that rates are going to remain higher for longer. And that's going to most likely, again, it's not guaranteed, but it is a scenario if we enter into a higher for longer interest rate environment, or an environment where inflation continues to uptick and the Fed has to bring rate hikes back to the table. It's a scenario that could unfold. Again, that's not unfolding now, but we need to keep it in the back of our minds. If it does, that could weigh on risk sentiment. Okay. So I wanted to bring that to the table, and I included an article that you guys can read and digest if you want to. It's right here. Then we have the yen carry trade. Okay, I feel like there's no need to introduce that, but the yen carry trade and potential Bank of Japan rate hikes, which as of right now are not on the table, but could be as we head into 2025. Again, we need to pay attention to economic data from the Japanese front, inflation data from the Japanese front, labor market data from the Japanese front, to determine whether or not the Bank of Japan could possibly hike rates. And if they do, we know based off of historical data, that tends to create rapid selling of risk assets and rapid buying of the Japanese yen. So another important factor to watch is the Bank of Japan and its interest rate policy. I'll leave it there. And here's an article. As a matter of fact, while we are on this call, I'm going to add this one to the report so you guys can read a bit about it, so I can save time and I don't have to go into too much detail. Just do some homework on that and why it could weigh on risk assets. All right. We've also broken that down in previous reports. And then last but not least, right, we have the geopolitical tensions and escalations. So, the geopolitical risks, they still remain a crucial factor, though recent developments under the new administration have brought hopes of potential de-escalation in regions like Ukraine and the Middle East. There is no guarantee of sustained peace until that is solidified and we see breaking headlines that the war has ended. Okay. So if these tensions do reignite or worsen, which obviously, of course, is kind of sort of that data that we can't necessarily predict, we just have to remain extremely adaptable and reactive to, because there's no dates when this stuff comes out. Albeit in this community, we have been paying attention to detail, and we have tracked and we've noticed that the vast majority of geopolitical tensions and escalations that tend to happen usually happen from Friday to Monday. Okay, that's just historical and that's just based off data. So again, I'd have heightened expectations from Friday to Monday of anything happening on the geopolitical forefront moving forward. Outside of that, right now, the market continues to remain risk on. Total cryptocurrency market cap on the day is up about 1.11%, which is extremely, cool in my eyes. We're back at 2.5 some odd trillion dollars. And it's been really cool tracking this stuff for you guys in real time and being able to call out these opportunities for you guys. Hopefully you all have been able to benefit from them. Most recently, On November 4th, I gave you guys DCA levels. These are the recent reports from all of those DCA levels that I was giving you guys. Top performer was Arrow and BST. In third place was Brett. And fourth place was Ondo. And then anything after that, I think I told you guys last Zoom call what I'm going to start doing in terms of these percentages moving forward.